Alright everyone, welcome back to the channel to the second installment on our two-part mini-series on divergences. In part 1, we discussed reversal divergences, also known as regular bullish and regular bearish divergence. We provided a definition and a high level of understanding on what divergences are. So if you've only come onto this video watching part 2, I highly recommend you go and watch part 1 before you jump into this episode. The link will be down in the description down below. With that being said, let's jump into today's episode where we're going to be understanding and identifying both hidden bullish and hidden bearish divergences. Let's jump right in. Alright, so let's start off with hidden bullish divergence. Now, just like in part 1, I have included the divergence cheat sheet to the left side of the screen so you can follow along with me while I do go through this. The left side of the divergence cheat sheet is going to be bullish divergence, and the right side of the cheat sheet is going to be for bearish divergence. For this section, we only need to focus on hidden bullish divergence. So, what is hidden bullish divergence? Hidden bullish divergence is a bullish continuation pattern in which the price action continues to bullishly diverge from a bearish oscillator. Now, just like in part 1 as well, we are using the RSI, also known as the relative strength index. So, how do we identify a hidden bullish divergence? You can identify hidden bullish divergence when you have lows followed by higher lows in the price action, and this is correlated to highs and lower highs over on the oscillator. So what does this mean and how is this a bullish continuation pattern? So you can think of this as the price action is bullishly moving to the upside because you've got higher lows followed up by higher lows followed up by higher lows, but what the relative strength index is doing is resetting. So as you can see, the relative strength index went from about 80 all the way down to 29, and the higher lows are still in play on this price action. So this should mean, in theory, that we should bounce and break bullish in this price action. Now, I would like to state something very important before we do move over to hidden bearish divergence. What I would like to say is we are looking at hidden bullish divergence currently playing out on the 1 hourly time frame, and we're going to be looking at the hidden bearish divergence playing out on the daily time frame. The daily bearish divergence has been playing out for almost a month now, but the hidden bullish divergence has only been playing out for 3 days on the 1 hourly time frame. So what I would like to say is when you do notice hidden bullish divergence, if you do have a higher time frame saying that there's hidden bearish divergence, then you should go with the higher time frame and you should go with the trend that has been in play for the longest period in time. For example, I've been doing TA on my channel. I am a crypto TA YouTuber if you haven't watched any of my videos before, and I have been talking about this, and I've had to move this trend line over multiple times because originally I actually had it drawn like this, where you had multiple touch points on this, and then I had to move it down like this, move it down, and move it down. And subsequently, almost every day now, I'm moving this trend line down, and the hidden bullish divergence on the hourly time frame is getting weaker and weaker and weaker. Why is it getting weaker and weaker and weaker? Because on the daily time frame, this hidden bearish divergence has been in play for over a month, and it is getting stronger and stronger and stronger with every day that passes. So subsequently, once again, you should always go with the higher time frame, and you should always go for the trend that has been in play for the most amount of time. Now, moving on, let's discuss what hidden bearish divergence is. So, hidden bearish divergence is a bearish continuation pattern in which the price bearishly diverges from a bullish oscillator. Let me show you how this works. So, over on the price action, you have highs followed up by lower highs, lower highs, lower highs, and lower highs. So as you can tell, the trend of the price action is to the downside, and as this is a bearish continuation pattern, this should mean that the trend will be continuing to the downside. Now, while the price action is making lower highs, the oscillator is making higher highs. So down here, you've got a high followed up by higher highs, higher highs, higher highs, higher highs, and higher highs. So why is this bearish, and why does this make sense from a technical perspective? Well, over here on the price action, let's just call this the local high. Now, when this local high was in place for Bitcoin, the RSI was down here around about 26. And if you know the RSI, you know anything below 30 is technically oversold. So while the price action was bearishly moving to the downside, and in the macro time frame, because you know down here you were having highs, lower highs, and lower highs, but then you came up for a macro lower high up here, but you can still see in the macro trend there is a downtrend in place. So while the price action is making lower highs, the oscillator is pushing up, and this means that the oscillator is getting more and more overextended with every pump back to the upside, even if it's a lower high. So right off the back, if we were looking at the micro time frame, you can see this is the local high down here while the oscillator's at 26. The next time you had a decent pump back up to the upside, it was round about here, and as you can tell, this was a massive lower high in the price action. Now, while this happened, even though we made a lower high, so typically you should expect the RSI, the relative strength of the market, to move down, the relative strength of the market was increasing, and another way of saying this was the market was becoming more overextended and exuberant, even though the price action was moving to the downside. And if we do look at the macro trend from this, where you've got the local high up here, followed up by another macro lower high, you can see the RSI moved from 26 all the way up to 48. So you could imagine, you know, if we extrapolate this trend line over a little bit, and let's just say, let's just imagine that we do something like this, and we bounce around and continue to make a series of lower highs on the price action, we would continue to witness the RSI becoming more and more overextended until potentially we peak our heads over 70 to 72. And when this happens, you can imagine that the market structure will be overextended, even though the price action is moving to the downside. So once again, this makes sense because this is a bearish continuation pattern, and it shows that when you are having these dead cat bounces up to lower highs, the strength of the market is becoming more and more overbought, even though the price is moving to the downside. And this is when typically you see hidden bearish divergence play out and you get continuation to the downside. So now we've watched both of these episodes, you should now understand what regular bullish divergence is, what regular bearish divergence is, and you should also understand about hidden bullish and hidden bearish divergence. Once again, remember that the higher time frames are the most important. We showed you an example of hidden bullish divergence that can potentially, keyword potentially, be playing out on the 1 hourly time frame, but we need to recognize that the 1 hourly time frame is a lower time frame than the daily, and this hidden bullish divergence on the 1 hourly time frame has only been playing out for 3 days, whereas the hidden bearish divergence on the daily time frame, bear in mind as well, daily time frame is a larger time frame than the hourly time frame, has been playing out for about 27 days to a month. So as you can imagine, the higher time frame, the more it's been going on for, the higher level of validity you should associate that trend with. And subsequently, if I was looking at these two charts and I was seeing this hidden bullish divergence on the hourly time frame play out, but I'm also witnessing hidden bearish divergence on the daily, I would be much more bearish than I would be on bullish, at least until the divergence on the daily time frame gets taken out. And to invalidate divergence, you need to break above or below where the trend started. So for this bearish divergence, for this to be invalidated, you would need to break above this level here, which is 23,400. Why this level? Because the divergence on the daily time frame started playing out right here. So if you do break above this, you will invalidate the hidden bearish divergence, and that could be a bullish indicator. Just like over on the hidden bullish divergence over here, you can see over on the RSI, this has technically been in place since 79, but you can drag this back somewhat around the price action. It is, you know, somewhat debatable whether you can do that. So let's just draw it from the peaks over here. So let's say if you did want to invalidate this hidden bullish divergence, you would need to take out the floor of where this hidden bullish divergence started to play out. So let's say, for example, if the price action moves to the downside and breaks below this level, 20,400, and moves to the downside, you can imagine that this hidden bullish divergence is going to be completely invalidated. So Once again, I hope you did enjoy the second installment of our Divergences episodes. And as always, my friends, cowboy out. Peace.